Greetings from our team at Rivera & Jones Wealth Management. This is Jack Jones, the managing partner, with our February monthly market update. So there's a lot of headlines to consume at present. Chief among them is the Russia invasion of Ukraine that's now going on approximately the 13th day. And brand new news as of this morning that it appears as if the US is going to ban Russian oil. That's obviously had an effect on oil prices that for a time recently hit 130, which is a 13-year high. You've also seen national gas prices top $4. And if things couldn't get more complicated, the same Russia that invaded Ukraine is part of the Iran nuclear deal that's being negotiated at present. So clearly a lot going on and a lot for the markets to digest. It may seem hard to believe, it does seem hard to believe that just under 2 years ago, April of 2020, WTI was trading at minus 37. So a lot's changed since then for a lot of different reasons, but it's interesting that this was just 2 years ago. So markets are responding understandably in a volatile way in response to the Russian invasion of Ukraine. The statistics that we're going to talk about here do nothing to minimize the human suffering that's going on in the Ukraine, but to highlight other geopolitical events over the last 50 years and how the markets have responded during the event and after. The most recent example that's comparable to where we are today, albeit on a smaller scale, Russia invaded the Ukraine and took Crimea in March of 2014. The number of trading days involved in the sell-off was 6, and it took 13 days to get back to prior highs. If you look at all of these events, one of the ones that stick out to me is 9/11, where markets traded down six days and we're back to new highs within 15. So that doesn't mean that the environment that we're in is the same as any of these other times, but a lot of really difficult times are encompassed in this last 50 years. On average, there's 12 days involved in the trade and the selling, and you're back to prior market highs within 5 months. And that includes the 50 years ago, the oil embargo of the early 70s, where it took almost 5 years to get back to prior recovery. So what happens when you have a bad start for stocks historically? So this is the 5th worst year for stocks, the first 2 months of 2022. And this goes all the way back to 1926. So on average, what happens in these other periods of time, again, what we don't know what happens here, but in the other periods of time, only 2 out of 10 were the next 10 months negative. And the big negative here is the financial crisis that bottomed in March of 2009. Volatility has clearly picked up. This measures the number of days where markets are up or down by more than 2%. Only 7 all of last year, already 4 year to date through end of February. Taking an even longer view, this looks at from 1926 to the end of 21, the S&P 500, and it looks at how many positive years versus negative years there were. 71 up and 25 down, the average up at 21, the average down at minus 13. So kind of in summary, what this is telling you is that almost 3 out of every 4 years markets are up. And when they're up by almost 2 to 1. Now that doesn't make the negative years or the times that we're in not painful, they are. But if you consider all that's underneath this period of time, including World War, a Great Depression, a lot of things are under this 96-year period of time. And again, almost 3 out of every 4 years, the markets are up on a calendar year basis, and the upside is almost 2 to 1 outpacing the negative. We share this chart a lot. This just kind of talks about how declines like we're in, while painful, are pretty normal. The average intra-year decline over the last 42 years is a negative 14%. So again, declines like these are never fun, but they are normal. So no one's really paying attention to the fundamentals now because the Russia, Ukraine, and geopolitical risk is so front and center. But there was a very good jobs report in February, job growth at just under 700,000, unemployment now at 3.8%. You also had wage growth of approximately 5% year over year. Now that didn't outpace inflation, but still overall a really good February jobs report. Also, the Fed did something that is very rare, which is they forecast what their rate increase is going to be at the end of this month, and they said it was 25. It's going to be 25 basis points, or 1/4 of 1%. It was thought to possibly be as much as 50 basis points, but again, the Fed did something they don't normally do, which is to indicate that it will be a 1/4 point at the end of this month. On the positive side, many of the COVID restrictions are being lifted. That should be good for the broader economy, specifically those in hospitality, as the pent-up demand gets out and spends money. So what are we doing? We did rebalance a couple of weeks ago to address some of the conditions of the market. We have both cash as a hedge, and we have, in addition to bonds, we have some commodity exposure as well that's helping out in this environment. We rebalance at least quarterly, and we're following things very carefully. So it's possible that we could rebalance intra-quarter, but no less frequent than quarterly. So what we'd encourage you to do is to contact us. Don't leave any question unanswered. We're here to serve you. So please be in touch. These videos are designed to talk generally about what's going on in markets, but they're no substitute to talking to you in person and how all of these items apply to you specifically. So with that in mind, we'll close. We again want to thank you for the trust and confidence that you place in us. The best part of our day is time spent serving you. And we again hope this note finds you well. And until we see you again, stay well and take care.